Welcome to The Explainer, where we dig into the data behind some of the biggest topics in the news. Today, we're looking at some aggressive new economic policies on trade and energy. The question is, how are they actually playing out? Let's dive in. So, we're 7 months into a new administration, and the central claim, as reported here by the Indian Express, is that these new policies have left the U.S. economy strong and robust, despite some pretty dire predictions. But the big question is, what does the data actually say? Today, we're going to put that claim to the test, digging into the two biggest policy pillars we've seen so far, sweeping new tariffs and a major shift in energy policy. All right, first up, let's tackle what the Indian Express calls the most consequential economic policy so far, tariffs. So what exactly are tariffs? Well, in really simple terms, it's a tax on imported goods. And here's the key thing to remember. It's not the foreign company that pays this tax. Nope, it's the domestic consumer. The whole point is to make things from other countries more expensive for us. And wow, have those costs gone up? According to an analysis by the Financial Times, the actual effective tariff rate, that's what importers are really paying, has just skyrocketed. It's jumped from around 2.5% all the way up to 9.1% since the start of 2025. That is a massive, more than threefold increase. Now this is where things get really interesting. Supporters of these new policies will often point to the stock market and say, see, everything's great. And, they're not wrong, kinda. The tech-heavy NASDAQ is up over 10%. But, and this is a big but, look at the Dow Jones Transportation Average. This tracks companies that actually move physical goods around the country. It's a key indicator for the real economy, and it's down 2%. That suggests there's a split reality here, where a few big tech companies are doing great, but the rest of the economy might be starting to feel the pain. So what's the most direct impact of making imported goods more expensive? It's pretty simple, right? Higher prices. And, well, sure enough, the data is starting to show exactly that. You can see that reversal happening right here on this chart. The Federal Reserve's target for inflation, the sweet spot, is 2%. And for the first few months of the year, things were looking good. Inflation was trending down toward that target. But ever since the new tariffs were announced, that trend has flipped. Now we see inflation climbing back up, getting closer and closer to 3%. And at the exact same time, the International Monetary Fund is forecasting a pretty significant slowdown in economic growth. After a solid 2.8% in 2024, they see it dropping to just 1.9% this year, and then all the way down to 1.2% in 2026. This combination of rising inflation and slowing growth, that's what economists call stagflation. And believe me, it is a very tough problem to fix. Okay, so that's the tariff side of the story. Now, let's switch gears and talk about the second major policy area, energy. The administration has made let's just say a very bold promise here. They've said that by rolling back regulations on the fossil fuel industry, they can cut energy prices in half for American consumers and do it within just 1 year. And, if you just look at the surface, the official forecast from the U.S. Energy Information Administration, we'll call it the EIA, it seems to back that promise right up. This chart shows Brent crude oil, the global benchmark, and the EIA projects it's going to fall a lot, from $71 a barrel down to around $51 next year. And of course, a drop in oil prices means cheaper gas, right? That's what we all care about at the pump. The EIA also forecasts that average U.S. gas prices will fall below $2.90 a gallon in 2026. So far, so good for that promise. Or is it? Well, not exactly. The crucial point here is why prices are falling. According to the EIA's own report, the big reason for the drop in oil prices is that OPEC+, the international group of oil producers, decided to increase production. That's a global market factor. It has nothing to do with domestic deregulation. In fact, as soon as you look past gasoline at the other ways we power our homes and businesses, the EIA forecast tells a completely different story. Yeah. Take a look. The price of natural gas, it's actually forecast to rise substantially by 2026. And the price you pay for electricity at home, that's expected to go up by 4% this year alone. The EIA says it's because production is basically staying flat while demand, especially from things like data centers, is just going up and up. All right, so let's pull all of this together. We've looked at tariffs, we've looked at energy. What's the bottom line when you look at all the data? First, let's talk environment. This EIA chart shows a pretty clear forecast for U.S. carbon dioxide emissions. The data points to a net increase for 2025, mostly because we're using more petroleum and coal, before it dips just a little bit the following year. And then there's this, a real twist. The Indian Express reports that these new tariff policies have actually made the US dollar weaker against other major currencies. What does that mean for you? It means every dollar you have buys less from other countries. It eats away at your purchasing power, and it makes those already taxed imported goods even more expensive. So, to wrap it all up, the analysis from the Indian Express concludes that while the economy hasn't fallen off a cliff, the data shows it is, quote, starting to suffer progressively. The key impacts are pretty clear: higher inflation, a weaker dollar that means we can all afford less, which leads to lower demand, weaker GDP growth, and ultimately lower employment. And all this really leaves us with one final crucial question to think about. In a world this interconnected, where oil prices are set by global players and our supply chains stretch across continents, how much control does any one domestic policy really have over our economy? It's something to chew on. Thanks for joining us.